An empty bank account and a five-figure balance create two very different psychological environments, even if the difference between them seems small on paper. And this shift does not begin with luxury or freedom but with something quieter, something more structural. Because the moment a person crosses into 5 digits, even just $10,000, the nature of financial decision-making begins to change in ways that are not immediately visible but deeply influential over time. And what makes this threshold important is not the amount itself but the way it alters perception, behavior, and tolerance for risk within a system that is constantly applying pressure to move money outward. At very low levels of savings, money behaves reactively, meaning that every expense, expected or unexpected, forces a response. And in this state, financial thinking is dominated by short-term problem solving, where decisions are less about optimization and more about survival. Because when resources are limited, the margin for error disappears, and even small disruptions like a minor repair or a delayed paycheck can create cascading effects, which leads to a constant cognitive load that prevents long-term planning from taking hold in any meaningful way. And as a result, financial progress becomes inconsistent, not because of a lack of discipline, but because the system itself demands immediate attention at all times. Once a person accumulates around $10,000, a subtle but critical shift occurs, where money begins to act less like a tool for reaction and more like a buffer against volatility. And this buffer changes the way decisions are evaluated, because instead of asking what must be paid right now, the question slowly evolves into what should be done next. And this difference may appear minor, but it marks the beginning of strategic thinking, where choices can be delayed, compared, and optimized rather than rushed. And this reduction in urgency is one of the first real advantages of crossing this threshold, as it allows time to re-enter the decision-making process. From a mathematical perspective, $10,000 is not a transformative amount in terms of returns, because even at a moderate annual growth rate, the absolute gains remain relatively small in the early stages. But the importance lies in the introduction of stability, because once a base level of capital exists, the percentage fluctuations of income and expenses have a smaller relative impact, and this reduces the probability of being forced into unfavorable financial decisions, such as high-interest borrowing or premature asset liquidation, both of which tend to destroy long-term value in subtle but persistent ways. Psychologically, this threshold also begins to reduce what can be described as scarcity-driven thinking, where the mind prioritizes immediate relief over long-term benefit. And while this mindset is often framed as a personal failing, it is more accurately a rational response to unstable conditions, because when resources are unpredictable, prioritizing the present is a form of risk management. But once a buffer exists, even a modest one, the brain starts to reallocate attention toward future outcomes. And this is where planning, investing, and delayed gratification become more viable, not because of increased willpower, but because of reduced environmental pressure. However, the system surrounding money does not become passive at this point, and in many ways, it becomes more sophisticated in how it encourages spending, because as financial capacity increases, so does exposure to higher-cost environments, whether through lifestyle expectations, social comparison, or convenience-based consumption. And this creates a new layer of decision-making where the challenge is no longer survival but restraint. And without awareness, the buffer that $10,000 provides can slowly erode through incremental increases in spending that feel justified but collectively prevent further progression. Historically, similar thresholds have existed in different forms across economic systems, where individuals or households reach a point of temporary stability but struggle to convert that stability into sustained growth, often because the surrounding structures are designed to capture excess capital through consumption rather than allow it to accumulate. And this pattern repeats across time, not as a failure of individuals, but as a reflection of how financial systems distribute incentives, rewarding immediate circulation of money over long-term retention. The key insight is that $10,000 is not a finish line but a transition point, where the rules of the game begin to shift from reactive management to strategic positioning. And understanding this shift is more important than the amount itself, because without recognizing the change in dynamics, it is easy to remain in reactive patterns even with a growing balance, which limits the potential benefits that the threshold is meant to provide. What ultimately determines the long-term impact of crossing this level is not the size of the balance but the change in identity that follows. Because when a person begins to see money not just as something to be used but as something that can absorb shocks, create options, and influence future conditions, the entire framework of decision-making evolves. And this evolution is gradual, often invisible, but it is the foundation upon which more complex financial systems, such as investing, compounding, and risk allocation, are built. In that sense, the first $10,000 does not change your life through what it buys, but through what it prevents, because it reduces the frequency of forced decisions, and in doing so, it creates the space necessary for better ones to emerge. And over time, this difference compounds, not only in terms of money, but in terms of clarity, control, and the ability to engage with the financial system on more deliberate terms, rather than being constantly shaped by its immediate demands.